Mandy, good morning.
Hey. How's your self-quarantine?
Myself quarantined, hermitized. We're living like hermits, like a lot of people. Are you guys pretty much doing the same?
I'm still going to work.
Really?
Mm-hmm.
We forgot. Okay. Getting there. Peyton, good morning. Mackenzie, good morning. Haley, good morning.
Good morning.
Good morning.
I can only say it 3 times before I start my coffee. Have you got your slides to chapter 9, stock valuation? Because that's what we're starting on. You'll need them. I sent them to you. You should be able to just open them up. There we go. Christopher, are you awake?
Yes, sir, I'm here.
I have no idea how many students will join these meetings live and how many will choose to look at the recording. Do any of you have an 11 o'clock class?
I don't.
Okay, okay. Some students do, and I talked to the dean about it, and he said they can watch the last 15 minutes of this class meeting in the recording. Carmen, I'm sorry about your book fee. It wasn't even my call.
Oh, no, you're good, Mr. Cudd. I talked to Mr. Brandon because it's from his class. Because when I got that book, I paid like from my own credit card. So why would I buy it like twice?
Yeah, they had a I'm sure the bookstore had a package deal, but did they reimburse you?
I don't know, because Mr. Brandon is not pretty good communicating by email. So, because I have a test Friday, and I texted him because tomorrow I'm flying back home, so I'm not going to make it on time Friday for the test. and he wasn't answering me. So I had to text Miss Kimmel. So after she texted him, he answered me. And I'm like, if you tell us to communicate with you via email because we don't have anything else, don't let me, yeah, exactly. Don't let me like that, because it's important what I was communicating to him.
Yeah. This is a time when we all need to respond as profs to our students and our students quickly. Josh, I know I didn't give you the answer you were looking for. The answer is just study harder for that final. But I did post your course averages. Hi, Vicki, you're sideways, or you were for a second. Now you're good. Guys, I've got almost 10 o'clock, so in a minute I'll start. Hutch, good morning. Got the earbuds going.
Morning.
That's a good lockout sound, I guess.
Do we start
Oh.
chapter 9 today?
Say again.
If we start chapter 9.
We are.
Okay.
You have I sent you the slides.
Yeah, I was just like opening the PowerPoint.
Yeah.
Okay.
By the way, one of you, Mandy, I think you were the one, asked me if the final will be all multiple choice and the composition. I had said 30% questions, 70% problems. Give me another day or two to rethink that.
Okay.
I have
Because
not
I was just,
put it together. It'll still be, there'll still be a question portion that's multiple choice. I don't know if it'll be 30 points or less or more.
okay, because your email said 30% multiple choice problems and then 30% multiple choice questions. So I was like,
Oh, did I say problems for both?
you said multiple choice for both of them, multiple choice problems and then multiple choice questions.
Well, the 30% multiple choice questions, 70% multiple choice problems is what I had intended to send.
Okay, because I was confused because there was multiple choice in front of both of them.
Yeah.
So I'm like, is the entire thing multiple choice?
Well, no, here's the deal. Probably.
I'll take that.
You like that. When we have, all right, when I have small graduate classes,
Mm-hmm.
the problem portion is all set up where they work out the problem, they work out the problems on scratch sheet, take a picture, send it in. And I get one problem for every student in the class to grade by hand. But it's a small number, so it's manageable. I've got two sections of your class. You're the small section. And the numbers become unmanageable for you having to simply show your work and mail it in. And I run into all kinds of problems when I try to get undergrad students to do this. The grads are so used to doing it. We get a big mess when I have students, undergrad students do it. So most likely,
Okay.
final
Thank you.
will be all multiple choice. The bigger portion problems, the smaller portion questions. I would like to put it together before I decide whether it'll be 30, 70, 25, 75, you know, whatever.
Yeah.
Well, good morning to those who I haven't said good morning to. Hampton, you're good. The funny thing I'm laughing at, I can see your cap and your eyes. You don't need to adjust your camera. It's not important I see you. It's important you see me, because then you'll be able to see the slides and the stuff I write on the whiteboard. All right. I do have one odd question, and I'm just curious, if we continue with this online format in the fall, which we may have to, how many of you think you'll be back taking classes?
I am.
I most likely will, but it all depends on if they decide to charge me for online or not. Because
I don't think they will.
certain colleges do certain things. You never know.
True.
Like some people who are residential students are signing a petition to try and get MC to refund room and board. And I don't know if they'll do it, but it all depends on MC, because they could consider it a giant loss of money.
Yeah.
It all depends on where it puts them financially.
Yeah. I'm certain the online classes will not be free. They're not now. They're not now. Had you taken this class as an online course from the start of the semester, the fee would be the same, I'm pretty sure.
Yeah.
You just wouldn't have some of the other, campus fees if you're not staying on campus. But I have no idea.
I'm a commuter student, so.
Yeah. Well,
but
not now.
No.
And maybe not in the fall. I have no idea. There are so many different stories. The top epidemiologists in the country first said it would take at least 18 months to develop a serum, a vaccine. But now they're fast tracking a lot of things and hoping to come out with it a lot sooner. We'll see.
Yeah. Well, if people would stop being stupid and stop going to the beach, that would be great.
The governor of Florida would agree with you. All right. And I did post your averages. I didn't bother to post all the different attendance points. What I did, I built it into the score you saw on the exam I gave back to you in class. So you've got 2 exam scores. They include attendance and the faith and ethics bonus points built in. You got your 30-point project. So those are the 3 scores you see plus your overall average. Anyway, those, if I don't know if you've used it or not, but you can go to Moodle and look in Gradebook, and there you are. Okay, chapter 9. Nine deals with stock valuation. You know, the 2 primary types of securities that corporations issue are stocks and bonds. We had a chapter back on the 2nd exam on bond valuation. Now we've got a chapter on stock valuation. Sorry about the coffee slurping, but if you want to hear me, I have to do that. Voice dries up. I thought you'd find this a little bit amusing. Who is this? This was Microsoft Corporation in 1978. And of course, that's Bill Gates. I'm just saying, if I were an investor and I looked at this picture in 78, would I have invested my money? Probably not. And look at where it's gone. So you never know. Okay. We're looking at 2 legitimate methods to value stock. And that's where most of our problems in this chapter will be. And there is a 3rd method, not so legitimate. It doesn't work real well, but people use it so much we cover it. The first method we'll look at is the oldest method. It's called the dividend model. For many years, every stock paid dividends. It was basically like flexing financial muscle. It was a demonstration that they could make money and have some left over. And this is at the heart of your literature in stock valuation. You'd get this no matter where you took the course. A second model, legitimate model, is called a corporate valuation model. These are the two models that we'll spend so much time on in this chapter. I figure today we will not get past the dividend model. The third model is use of price multiples. And the problem is they're misused more than used properly. And they're not sophisticated. The dividend model and corporate valuation model are solid models, solid theory, and they cover a lot of things. The price earnings multiple is more of a rule of thumb model. All right. What does the dividend model assume? Basically, it assumes that the value of a share of stock is the present value of all future cash dividends. If you think that at the very basic concept of valuation, we use this with the bonds back in the bond chapter. We basically say the value of any security is the present value of all future cash benefits. Now with bonds, of course, bonds had a maturity, so they didn't pay benefits forever. With stock, stocks don't have a maturity date. So we begin by assuming they pay dividends forever. Now, one simplification. In this book and in my slides, we treat the dividend model as if the dividends are paid annually. In real life, they're paid quarterly. Now, it's way above a principles level class to understand this. But by assuming the dividends are paid annually instead of quarterly, it actually corrects for a bias when we use the dividend model. But for now, think of this as just a way to keep things simpler. Okay, now I'm about to wipe a little critter off the screen. There we go. All right. Didn't know what it would do. Now, back in time value, the very first equation, well, it wasn't the first, it was a rearrangement of the first equation. We said the value of any future payment, the present value of any future payment could be found by dividing by 1 plus our discount rate raised to some power, the power being the number of years. So, for example, if we wanted to find the present value of a dividend received 3 years from now, we would take that dividend, divide it by 1 plus our discount rate, and for stock, we use R sub S. Back in your bond chapter, we used R sub D, D for debt, S for stock. So for example, let's say I've got a dividend in year 3 of, I don't know, $2. Stockholders want a 10% return. The present value of that dividend would be that dividend in year 3 divided by 1 plus our discount rate raised to the third. T would be 3 because we're discounting it 3 years back to get it back to year 0. So this would be $2 divided by 1 plus, and just like in our time value problem, when we use an algebraic formula, the discount rate has to be in decimal form. And since I'm making this up on the fly, give me 1 second. And that'd be $1.5026 if I carry it out a little bit. So that's how we find the present value of one dividend. Now with our dividend model, sorry guys, I'm still slow at punching and poking. How many terms do we have? How many dividends? An infinite number. Notice that ... at the end. This would be the present value of D1, D2, D3, D4, D5, D6, and I keep on counting. A mathematician would tell you that's a power series. Don't freak out. You're not going to have to use it in that form. It simplifies. Graphically, we'd be taking all the future dividends and discounting them back to the present. That's what we'd be doing. But if we can assume the dividends grow at a constant rate, then at some rate G, then the dividend in year 1 would be G% bigger than the dividend in year 0. Like you, if you got a 5% raise every year, that would be a good analogy. So for example, what am I looking for? There we go. Just to clear this up, let's say D0, I don't know, was $2. Now that is defined as the dividend for the year just ended. If you want to, think of today as January 1, and this was the dividend paid yesterday. So if we buy the stock today, we don't get D0. We just missed it. But if these dividends grow at a constant rate, let's say the growth rate is 5%. Sorry about my handwriting, guys. It's terrible. That's why I use PowerPoint. Then the dividend in year 1 would be the dividend in year 0 times 1 plus that growth rate, or $2 times 1 plus 0.05. Well, yeah, 1 plus 0.05. That'd be 210. My goodness, my handwriting stinks. That would be the dividend we'd expect to receive a year from now. Then the dividend in year 2 would be the dividend in year 1, but G% bigger. I just wrote 1 point. You know that 1 plus 0.05 is 1.05. And that would be, sorry, again to the calculator. 2.1 times 1.05. Carrying out a little bit, that would be $2.205. And then the dividend in year 3 would piggyback and say that would be D2, but G% bigger. and that'd be 2.315. I'll round it a little bit, and so on. Okay. Something else we could do, we could also say the dividend in any year T would be the dividend in year 0 times 1 plus the growth rate to the T power. So another way we could have found the dividend in year 3 would have been to take the dividend in year 0, $2, times 1 plus that growth rate at 5%, and raise it to the 3rd power. And that would also give us the 2.315. Let me double check the figures. Yeah, okay. So just trying to give you an idea of what we're assuming about the growth in dividends. Each dividend is 5% bigger than the last. And by the way, that little formula comes in handy now and then. Now, if we make that assumption, our formula looks even scarier. If we assume that each dividend is G% bigger than the last, and by the way, this would be the same thing as saying that D2 is D0, sorry about that line, times 1 plus G raised to the 2nd. See if I can get rid of that line. So if we make this assumption that each dividend is a constant % bigger than the last one, then our power series looks even worse. Looks more complicated, but if you get a mathematician to come in and look at that, the mathematician would say that's a well-behaved power series, because this long, messy formula with an infinite number of terms in it reduces down to this. They're one and the same. What is this? That's an algebraic present value function for a series of payments that go forever but grow at a constant rate G, and where the first payment is on top there, and R sub S is the discount rate. If you ever sue for lost wages, say you get injured on the job and you lose the ability to earn for the rest of your life, believe it or not, this is the model they'll pull out in court. I've been called in as an expert and had to use it. It's a simple time value function. You have to adjust it. You wouldn't live forever. So I had to tweak it quite a bit, but the point is, this simple ratio is a very sophisticated present value function, and it's useful. Now, keep in mind, what does the constant growth rate dividends mean? You tell me, if you got a job and you got a 5% raise every year, would your dollar raise be the same each year? Keep the math simple. What if you're making $50,000 and you get a 10% raise? That'd be another what, 5,000? If you got a 10% raise the following year, would it also be just 5,000? what would you expect to happen to the dollar size of your raise each year if you get a constant % bump in your salary? You expect the dollar raise to get bigger, so it wouldn't go up like a straight line. Instead, it would sort of curve up. That's what we're assuming about dividends. That's what you'd be looking at for your salary if you were working and got the same % raise every year. All right, Cudd, you're scaring them. Too much theory. This is what you need to know, how to use it. Okay. Let's say we've got Cobb Corporation. The stockholders, because of Cobb's risk, they want a 15% rate of return. The higher the risk of the company, the higher would be their required rate of return. Maybe they got that from running the numbers through the CAPM, for all I know. Key point is the stockholders want a 15% rate of return. That's their time value of money. So that's our so-called discount rate. Cobb paid an annual dividend for the year just ended of $2. And we're expecting the stock to grow at a 5% rate every year, forever. So using our simplified time valued money formula, the one that looks like this, the value of the stock is equal to the dividend in the coming year divided by the stockholders' required rate of return or discount rate minus that growth rate. And by the way, the funny little hat that I put on it, that just means estimate. That's our estimate. If you want to, you can ignore the hat. So Cobb, the value of Cobb's stock now is at $2 we're expecting. Well, better yet, we'd need D1, wouldn't we? D0 times 1 plus G. So if the dividend for the year just ended was $2 and the growth rate is 5%, then the dividend expected in the coming year is $2.10. Because this is an algebraic time value formula, all the interest rates have to be put in decimal form. So instead of putting 15 for R sub S, we would put 0.15. And for the growth rate, instead of putting 5%, we'd put 0.05. And we'd come up with a value for the Cobb stock of $21 per share. That's what we think it's worth. Another name for what we think a stock is worth is the intrinsic value. If you had confidence in the model, if you thought the assumptions were solid, your estimates were solid, then $21 is what you would place as the value of the stock right now, P sub 0. So the most you ought to pay for a Cobb stock is 21. If you're an investor, you'd like to pay a lot less than 21 because you think it's worth 21. If you look in the market and it's trading for like $25 a share, you'd say no thanks. It's priced too high. It's only worth 21. Now, just for grins, try this one. Do you have questions? I need to pause and ask if you have questions. Do you have questions at this point? I'm sleepy too, Carmen. Okay, Carmen, sorry. Let's say we got the following problem. I don't want to use one I've got in the slides. Let's say Rimsky Corporation has the following information. Based on Rimsky's risk, stockholders want a 20% return. They think dividends will grow forever at a, I'm just making this up, 4% rate. And the dividend paid in the year just ended was $1. Take a second. Tell me what you come up with for the value of Rimsky stock. It won't be a nice round number, I don't think. Woo, it is a nice round number. That was an accident. Anybody, what'd you come up with? Or am I rushing you? No pun intended. Rimsky-Korsakov is the most famous Russian composer. Never mind.
6.5.
6.5. Bingo. And the way she got that, let me get this out of the way and make a little bit more room. Since you were given D0, first you'd find D1. $1 times 1 plus 4% would be $1.04. Then you'd plug it into the formula that says you take the dividend in the coming year, D1, divided by R sub S minus G. Oh, Cudd, why didn't you take a course in handwriting? So $4 point what? What's 20% in decimal?
0.20.
0.20. Now this is one that kills me. What's 4% in decimal?
0.04.
0.04. You know what? A ton of you on a test. Don't ask me why. We'll call 4% in decimal 0.4. 0.4 would be 40%. I don't mean to insult you, but I just want to caution you to that mistake. So we think Rimsky stock is worth $6.50 a share. If we're thinking about buying it, that's the most we would want to pay. We'd like to buy it for less. If it's trading at a higher price, we'd say it's overpriced. We won't invest in it. Okay, I don't mean to bore you to death, but one more problem. I'm going to change things up just a little bit. Save a little time. Instead of Rimsky, we'll go with Korsakov. That's his last name. Actually, he has a hyphenated name, but let's say the Korsakov Corporation. Sorry for these embarrassing pauses. Let's say the Korsakov Corporation. Stockholders require a rate of return of 12%. They think the dividends will grow forever at a 7% rate. and the dividend in the coming year is $5. What do you get for the value of this stock? Anybody?
Is it 100?
Let's see.
I got 107.
Well, let's see. First of all, do you need to find D1 or were you given D1? You were given the dividend in the coming year, so you could skip this step, right? Aha. I saw an aha look on somebody's face. So it would be $5. We can plug it straight in. We're given D1. Then with a 12% required return and a 7% discount rate, shameful, I pull out my calculator for this, $100. Yeah. Are you with me on this?
Yes.
Whether or not you need to go through this little step depends on whether you're given D0 or D1 in the problem. Whether you're given the dividend for the year just ended last year, or you're given the dividend for the coming year.
Mr. Cudd,
Sir,
would there ever be like a circumstance where they give us like D2, or
no,
is it always going to be D0 or D1?
you'll be given, to answer your question, there's a messier type of problem we're going to look at where we have to calculate D2. So for problems straightforward like this, you'll either be given D1 or D0.
Okay, thank you.
It'll make more sense. My answer to your question will make more sense when we get to that other kind of problem. All right, now, sometimes you know what you want your required return to be and you're calculating price. But sometimes it's the other way around. You're given the price and asked to calculate yield. For example, here's our Cobb Corporation stock, and we found an intrinsic value for the stock of $21 because we knew what we wanted our required return would be. But what if you find out you can buy the stock for $15? What is your expected rate of return? If you take that basic formula, the price is D1 over R sub S minus G, you can rearrange it. If you rearrange that formula, you could rearrange it to solve for R sub S. You get D1 over P0 plus G. Same formula, just rearranged to solve for R sub S instead of P0. So if we could buy that Cobb stock, let's see, for Cobb we had a we have a dividend for the year just ended of $2, growth rate in dividends of 5%, and now we're looking at a price. We're given a price of $15. Should have used a different number. Then to find our expected rate of return, which would be our SBES, we would take this formula. Looks like we're going to have to do that little preliminary step again. D1 would be D0 times 1 plus G, or 2 times 1.05 would be 210. And then we plug it in. Our SBES would be D1 over P0 plus G. So we'd have, I'll do it in red, 210 over our stock price of $15 plus G. Since this is still that algebraic time value formula, you still need to put G in decimal form. So we'd have this plus 0.05, and we get an answer in decimal form, so 19%. That would be our expected rate of return. Remember earlier we said that the value of the Cobb stock when we first worked it, the value was $21, right? If you can now buy the same stock and pay less, pay $15, what should that do to your rate of return? It ought to be higher. Instead of 15%, since we can buy it at a lower price than 21, we get a higher return. That makes sense. Back in your bond chapter, we talked about bond yield, that's the return on a bond, and bond price as being inversely related. If yield goes up, the bond price would go down. If yield goes down, the bond price would go up. You could have turned it around and said, if the bond price is higher, your yield would be lower. If the bond price were lower, your yield would be higher. That's true for all financial securities. So with stock, if the price drops, your rate of return goes up. They're inversely related. Stock price and stock yield or stock return, this thing we call our SBES, are inversely related. All right, help me out with my memory. We had a problem earlier that I called, what I call it, Rimsky. Where the dividend for the year just ended was $1. Am I remembering this correctly, guys? I didn't have it written down. I made it up. And the stockholders wanted a 20% return. And we came up, oh, and a growth rate of, what was it, 4, 5, 4, right? And we came up with a price of $6.50. Double check my numbers to make sure I'm working the right one. Yep. Okay, let's turn it around. What if we can buy the stock? Let's say the cost of the stock would be $8 a share. What would be our expected rate of return? Again, we're trying to solve for rate of return. And we weren't given D1, so we'll need to calculate it. $4. And if we plug it in, and we're able to buy the stock at $8. Whoops, sorry. There. And then the growth rate would go in as how, guys? 4? .04, right? Decimal. And your answer comes out decimal. I have no idea what the answer is going to be. It's nice though, it's nice and around 0.17 or 17%. Originally, we looked at the case where if we paid $6.50, our return would have been 20%. If we now pay more for the stock, $8 instead of $6.50, what should that do to our return? Higher price, lower return. And we'd be going from 20% down to a 17% return. Price and return are inversely related. The one tricky thing about using our formula where we're calculating return is to remember that G must be in decimal form. Said it backwards. So if the growth rate is 4%, we put it in as 0.04. And the other thing to remember, I'm looking for another color. I'm running out of good colors, guys. I'm going to go pink. Is to remember that the answer will first come out in decimal form. This is all part of that very first basic dividend model I showed you, where price was D1 over R sub S minus G. And I told you that that was a time value function, algebraic time value function. So these had to be in decimal form. So it's no surprise that if we rearrange it to solve for R sub S, the answer comes out in decimal form. Okay, I do this in class. I did back when we met. Where's your confidence level with this so far? Feel fairly comfortable? Good. I got a thumbs up from Tori. All right. Now, I'm skipping the Zumba Corporation slide. I want you to have some slides with problems for you to work on your own. So if we fast forward ahead, skip Zumba. I'll let you do that one. In the world of the dividend model, if dividends grow at a constant rate, the stock price has to also. Don't really worry about earnings per share. So just like earlier, if we could say the dividend in any year T is the dividend for the year just ended, D0 times 1 plus G to the T, we can say the same thing for the stock price. Don't worry about that middle formula. You won't see it. Key point is this. If you assume dividends grow at a constant rate, then the stock price has to grow at that same rate if it's a forever rate. So for example, what if you have a problem like this? This was our original stock. I don't know if I gave it a name or not. Yeah. Yeah, this was the Cobb stock, I think. $2 dividend for the year just ended, a 5% growth rate. And may I change one thing up in this problem? Let's say, well, no, you don't need it. Just ignore the earnings, all right? Let's say the stock price right now is $21. And the dividend for the year just ended was $2. And one other thing you do need that I didn't give you, I apologize for that. Assume that the growth rate in dividends is 5%. So the stock's worth $21 now. The dividend for the year just ended was $2. And we're forecasting a forever growth rate of 5%. Then what would be the dividend in year 6? Again, ignore this little one. We take the dividend for the year just ended, multiply it by 1 plus that 5% growth rate, and raise it to the 6th power. And we get a dividend in year 6 of $2.68. Well, likewise, if we wanted the stock price in year 6, we could take the stock price right now, which is 21, multiply it by 1 plus that growth rate, raise it to the 6th power, and we think the stock 6 years from now ought to be trading for a little over 28 a share. Grow at 5% a year. For example, let's say, oh, I'm going to get out of pink so quick. All right. Let's say we've got a Rimsky stock. The dividend for the year just ended was $1. The price of the stock right now is $6.50. It's trading at its fair value. And we think dividends will grow at a 4% rate forever. What would be the dividend in year 10? What would be the stock price in year 10? Take a second and tell me what you come up with. All right, why aren't you turning on? Does it have to be that way? There we go. What'd you get for the dividend in year 10?
2.48.
248 or 148?
2.
I'm getting 1.
Sorry. Yeah. My bad.
Okay. The dividend for year 0 was $1 times 1 plus the growth rate raised to the 10th. I'm getting $1.48. And for the stock price now is $6.50. If it grows at a 4% rate for, what did I say, 10 years, is anybody getting $9.62? Cool. And of course, dividends per share, stock price per share. Do any of you need a brief trip down memory lane on the keystrokes? No one is speaking up. So, all right. We went through that back at the time value chapter. Okay, now, yield components. And I'll skip those so that you'll have something to work with. When you buy a share of stock, you actually have 2 components of yield. Well, if you think about it, if you buy a share of stock, what are the 2 good things that can happen? It can pay a dividend, and then the stock price, you hope, will do what? Go up. If you buy a share of stock, the 2 ways you get return is they may pay you a cash dividend, and of course you may get a capital gain return from the stock price rising. So I'm going to go to my whiteboard and replicate some of the slides, just so much easier. Here is your dividend model rearranged to solve for return. D1 over P0 plus G. The dividend over the stock price is your dividend yield. You saw this back at the start of the risk chapter. And since in the world of the dividend model, the stock price has to grow at the same rate of return as the dividends, then G is not only the growth rate in dividends, that's the growth rate in the stock price. By another name, we call that the capital gains yield. Terrible handwriting, boy. We did this at the start of the prior chapter, chapter 8. Dividend yield and capital gains yield. So for instance, what if we've got Cobb stock? And we're told that the value of the stock right now is $21. We think dividends will grow at a 5% rate forever. And the dividend expected in the coming year is $2.10. What if you're given this information? Then your total return would be D1, which is 210, over the value of the stock, which is 21, plus that growth rate in dividends, which is 5%. So your total return would be, and by the way, this in decimal works out to 0.10, I believe. So your total return would be 15%. Now the question is, how much of that 15% is dividend yield? How much is capital gains yield? Well, your dividend yield in percent form would be 10%. Your capital gains yield in percent form would be the other 5%, giving you your total return of 15. One of the cool things about the dividend model is it separates your two components of return, your dividend yield and your capital gains yield. It just naturally lays out that way. So let's say I keep flipping ahead to make sure I don't make up something I've already covered. Let's make up a problem. Better yet, let me see if I can use one I already had. Trying to keep my eye on the clock here. Let's say that, well, what did we have earlier, Rimsky? Rimsky Corporation, we had a stock price. Whoa, that's not supposed to happen in whiteboard. We had a stock price of, what was it, 650? We came up with, where stockholders were actually requiring a 20% return, and the growth rate in dividends and in the stock price forever was 4%. Now let's see what we get if we try to break that down into its two components. Oh, and I didn't give you the, what did I use for dividend for this? $1? Yeah. Dividend for the year just ended was $1. So first, since we're given D0, we need to find D1. Do a little bit of house cleaning, as we call it here. So that'd be about $1.04. Why isn't this thing writing? There. And I'll do a little house cleaning of my own here. All right. So the question is, in your total 20% return for Rimsky, how much of that is dividend yield? How much is capital gains yield? Well, your dividend yield would be what, $1.04 over 650, and your capital gains yield just be G. Whatever the growth rate is in the long run in dividends, it has to be the growth rate in the stock price. Only we need to be careful and put it in what form here? Decimal. So if you crank this out, I think that works out to 0.16. So to get your total return of 20%, looking at a 16% dividend yield, and a capital gains yield of 4%. And of course, that gives you your total return of 20. Now, I'm purposely going really slowly. I hope you don't mind. I think giving you additional problems, slipping them in is a good way to go. Questions? I have one for you. Why didn't I just plug that $1 in for D1? Because it wasn't D1. It was D0, last year's dividend. We had to calculate D1. Just pointing that out. All right, now, what happens to the stock price if different things happen? For instance, and I'm skipping ahead now. I did that on the slides. All right, now, finally, what happens to the value of the stock if we now decide we've got a higher growth rate? With a higher growth rate, we get a higher value of the stock. For example, we found the value of the Rimsky stock. We found the value of the stock based on a 4% growth rate to be 650. Uh, what happens now if the growth rate goes from 4% to, I don't know, 6? What happens to the value of the stock? That'd be 1.06. This would be 0.06.
Hey.
757. The key point is that and I could express it this way, by the way, guys, same formula. That is D1. If we change our mind about the growth rate and think it'll be higher, that leads to higher stock price. What happened in the stock market yesterday? What did the market do? Jumped a mile, didn't it? You know why? Analysts looked into the future and decided the economy was going to be better off. Somebody's got a lot of static going in the background. Why don't all of you mute your mics for a second? Yesterday, analysts decided the economy is going to be better in the future. So they upped the growth rate in earnings and dividends and everything for all stocks, pretty much. And that led to a jump in the value of all stocks, so a jump in the value of the market. But what if another situation occurs? What if, again, we'll pick on Rimsky. Right now, stockholders want a 20% return. Dividend in the coming years, $1. Guys, will all of you mute your mic? One of you is getting some bad feedback. That did it. Okay. And we were basing this on a growth rate of 4%. Now, so we came up with a value for the stock. Of 650, right? Now, what if investors decide the stock is riskier? If investors decide the stock is riskier, what will they do to their required return? Won't they increase it? Let's say they increase the required return to 25%. Then what happens to the value of the stock? Guys, I can go through and mute you one at a time, but please mute your mics, those two, whoever is not doing it. So now if we have a 25% return because the stock looks riskier, What happens to the value of the stock? It's $4.95. Drop. That's what the stock market has been doing for the last few weeks. Most days. Everything looks so risky. It's causing stock values to fall. So if I ask you on a test, if investors decide there'll be a higher growth rate, what happens to the value of the stock? It goes up. If investors decide the stock is riskier, maybe either cap in to use a higher beta, so it gives them a higher required return. The value of the stock will go down. I want to ask why stock prices fluctuate so much. Okay. If you want to ask why the prices fluctuate so much, investors by the minute keep changing their mind about what the future growth rate in earnings and dividends will be. And they keep changing their mind about the risk. Here's your model. If they think there'll be a higher growth rate, that makes D1 bigger, that makes G bigger, that makes the stock value bigger. If they think the stock will be riskier, they'll increase their required return. Faced with higher risk, we require a higher return, and the stock price goes down. So throughout the day, the outlook for growth rate keeps changing. You do it this way. If the growth rate is revised downwardly, the price goes down. If it's revised upwardly, the price goes up. If the risk is revised to be higher, required return goes up, stock price goes down. If they decide things are safer, they lower their required return and the stock price goes up. But minute by minute, investors keep changing their minds. And that's why stock prices fluctuate. At least explained in terms of the dividend model. How you doing so far, guys? It's actually time to adjourn. Any questions? Where's your confidence level with this so far? Pretty good? Josh, can you give me a thumbs up or a thumbs down or a thumbs sideways, wavy hand? I'm not sure. Thumbs up. Oh, look at that. I didn't know you could do that. I need to learn how to do that. All right, guys, we will pick up with this when?
Monday.
Monday? Yeah, today's Wednesday. Yay. I thought today was, I don't even know what day of the week it is. We'll pick up next Monday at 10 o'clock. We'll pick up right where we left off with the dividend chapter. I'm trying to go really slow so none of you get left behind. Forgive me if it's just boring you to tears. All right, guys, stay safe. I'll see you Monday.